Thanks for tuning in to Financial Success. Today we're going to go over some of the basics that you should know about how your investments are going to affect your taxes. Let's dive right into this one. There's a couple ways that you can essentially not pay any taxes. The first of which, as many of you have heard of, is called a Roth IRA. Now, there are certain income limitations, but most people are able to put money into a Roth IRA up to $5,500. So how this works is it's basically if you follow the rules as far as when you put in money and when you take it out, you basically will pay no capital gains taxes at all. So the idea is it was developed by the government to help people plan for retirement. And you can put in, like I said, roughly $5,500 every year. You cannot withdraw it until you reach retirement age, but you can withdraw the principal you put in there. You just cannot take out any interest earned on that account before you reach retirement. It's a great deal, and I recommend anybody take advantage of that. A similar thing a lot of employers will actually offer is what's called a 401k. Now, with a 401k, you don't have to pay taxes on any of the money you put in, but when you take the money out, when you reach retirement, you're going to have to pay taxes on that money. So I've always preferred the Roth IRA. Now, a big thing to keep in mind, a lot of employers will match, and that means is that say you put 5% of your salary into your retirement fund, they will put another 5% for you. So always take advantage of that if it's offered. Now, individual investments, less rules. You can put it in, you can pull it out whenever you want. This is what most people think of classic investing. However, there are tax implications on when you put the money in and when you take it out. Now, we'll go ahead right now and take a look at this graph. Okay, so we're looking at 4 columns here. The last 2 are whether you file single or file jointly. And the first 2 columns are short-term capital gains and long-term capital gains. You'll notice there's 2 different columns for that because short-term capital gains are taxed much higher than long-term capital gains. What short-term means is that you bought and sold the stock within the same year. Long-term means that you held onto the stock for at least a year. So if I say I make $100,000 a year as a single person, I would pay 28% of all my earnings if I bought and sold my stock within the same year. But if I held onto that same stock for just over a year, I would only pay 15%. So as you can see, it's very advantageous to be a long-term investor when you're looking at taxes. All right, that's just a few of the basics, the fundamentals that anybody should know when they're investing regarding taxes. So, thanks for watching Financial Success.